Solved problems. Adjusting entries, worksheets, income statement, balance sheet, statement of changes in partner's capital, closing entries, and new profit sharing ratio on admission of a new partner. The problem. From the following ledger balance of 2 and 1 general merchandising, prepare 1. Adjusting entries, 2. Worksheets, 3. Income statement, 4. Balance sheet, 5. Statement of changes in partner's capital, 6. Closing entries. 2 and 1 general merchandising trial balance as of December 2020. Account debit, credit. Cash debit 36,000. Accounts receivable debit 120,000. Allowance for bad debts credit 30,000. Notes receivable debit 30,000. Merchandise inventory January 1 120,000. Land 100,000. Buildings 500,000. Accumulated depreciation buildings credit 50,000. Accounts payable credit 72,000. Notes payable credit 75,000. 2 capital 284,000. 2 drawings 20,000. Chan capital 350,000. Chan drawings 10,000. Sales 950,000. Sales returns and allowances 22,000. Sales discount 2,000. Purchases 500,000. Purchase return and allowances 15,000. Purchase discount 14,000. Wages 98,000. Advertising expenses 45,000. Rent expenses 50,000. Freight out 28,000. Interest expense debit 7,000. Miscellaneous expense debit 128,000. Interest income credit 4,000. Total debits 1,830,000. Total credits 1,830,000. Adjustments. A. Data for adjustment. Year ending December 31, 2020. 1. Merchandise inventory December 31, 250,000. Depreciation of buildings 10% annually. 3. Allowance for bad debts is to be increased to 20% of accounts receivable. Unpaid salaries 30,000. 5. Prepaid advertising 5,000. B. Profit and loss agreement of Tua and Chan are as follows. 1. Salary allowances to Tua as the managing partner in the amount of 60,000. 2. Each partner shall be allowed a 6% interest on their beginning capital balances. 3. Balance in the ratio of 3:2. C. Partners agreed to admit CO as partner in the following assumptions. Assumption 1. CO purchases 1/2 interest of Chan for 200,000. CO purchases 1/3 interest of Chan for 97,000. After the admission of CO, give the new profit and loss ratio in each case. Solution. Adjusting entries. Entry 1. Merchandise inventory asset debtor 250,000. 2. Trading account merchandise inventory 250,000. 2. Depreciation of buildings 10% of 500,000 50,000. 2. Accumulated depreciation of buildings 50,000. Adjustment entry number 3. Allowance for bad debts 6,000. 2. Profit and loss account allowance for bad debts 6,000. Entry number 4. Salaries debtor 30,000. 2. Outstanding salaries 30,000. Adjustment number 5. Prepaid advertising 5,000. 2. Advertising expense 5,000. Salaries and interest partners as per agreement. 6. Salaries to Tua profit and loss account debtor 60,000. 2. Salaries to Tua capital account 60,000. Interest on capital debtor 38,040. 2. Tua's capital 284,000 at 6% 17,040. Chan's capital 350,000 at 6% 21,000. The original trial balance as given in the problem is here. Now we need to prepare worksheet for the adjustments, income statement and balance sheet. Let us post the adjustments against the trial balance. Adjustment number 3. Allowance for bad debts 6,000 debit. This is actually we need to maintain 20% of the accounts receivable as allowance for bad debts. We have already 30,000 in our allowances, so it should be reduced to 24,000. So we need to debit allowances for bad debts with 6,000. Next adjustment. Accumulated depreciation on buildings 50,000. 10% of 500,000. Towards capital, credit 77,040. This is his salary 60,000 plus 17,040 towards his interest on capital. And chance capital credit 21,000 towards 6% interest on his capital. Next, salaries and wages debit 30,000. Advertising expenses credit 5,000 because 5,000 goes for the prepaid. Depreciation on buildings 50,000, 10% of 500,000. Interest on capital debit 38,040. Merchandise December 31 inventory 250,000 on the debit side. Outstanding salaries 30,000 credit. Prepaid advertisement 5,000 debit. Allowance for bad debts profit and loss account 6,000. 30,000 minus 24,000. Salaries to Tua profit and loss account 60,000. Merchandise inventory trading account on the credit side 250,000. Total adjustments is 439,040. Total adjustments credit 439,040. Let us prepare the adjusted trial balance after adjustments. It goes like this. Cash debit 36,000. Account receivable debit 120,000. Allowance for bad debts 24,000 credit. Notes receivable 30,000 debit. Merchandise inventory January 1 120,000 debit. Land 100,000 debit. Buildings 500,000 debit. Accumulated depreciation of buildings 100,000 credit. Accounts payable 72,000 credit. Notes payable 75,000 credit. Towards capital 361,040. Towards drawing 20,000 debit. Chance capital 371,000. Chance drawings 10,000 debit. Sales 950,000 credit. Sales return and allowances 22,000 debit. Sales discount 2,000 debit. Purchases 500,000 debit. Purchase returns and allowances 15,000 credit. Purchase discount 14,000. Salaries and wages 128,000. Advertising expenses 40,000 debit. Rent expenses 50,000 debit. Freight out 28,000 debit. Interest expense 7,000 debit. Miscellaneous expenses 128,000 debit. Interest income 4,000 credit. Depreciation on buildings 50,000 debit. Interest on capital 38,040 debit. Merchandise inventory December 31 250,000 debit. Outstanding salaries credit 30,000. Prepaid advertising 5,000 debit. Allowance for bad debts profit and loss account 6,000 credit. Salary to Tua profit and loss account 60,000 debit. Merchandise inventory trading account 250,000 credit. Total debits of the adjusted trial balance is 2,258,040. On the credit side also total 2,258,040. Prepare the income statement in the worksheet. Merchandise inventory January 1 debit 120,000. Sales credit 950,000. Sales return allowances debit 22,000. Sales discount 2,000 debit. Purchases 500,000 debit. Purchase returns and allowances 15,000 credit. Purchase discount 14,000 debit. Salaries and wages 128,000 debit. Advertising expenses 40,000 debit. Rent expenses 50,000 debit. Freight out 28,000 debit. Interest expense 7,000 debit. Miscellaneous expenses 128,000 debit. Interest income 4,000 credit. Depreciation on buildings 50,000 debit. Interest on capital 38,040 debit. Allowance for bad and profit and loss account 6,000 credit. Salaries to Tua profit and loss account 60,000 debit. Merchandise inventory trading account 250,000. Total debits in the income statement is 1,187,040 and on the credit side 1,225,000. So the difference of 37,960 is the profit and it will be shared among the partners. Let us post the entries in the balance sheet in the worksheet. Cash debit 36,000. Account receivable debit 120,000. Allowance or bad debts credit 24,000. Notes receivable 30,000 debit. Land 100,000 debit. Buildings 500,000 debit. Accumulated depreciation on buildings 100,000 credit. Accounts payable 72,000 credit. Notes payable 75,000 credit. Tuas capital credit 361,040. Tuas drawings 20,000 debit. Chance capital 371,000 credit. Chance drawings 10,000 debit. Merchandise inventory December 31 debit 250,000. Outstanding salaries 30,000 credit. Prepaid advertising 5,000 credit. Total debits on the asset side in the worksheet comes to 1,71,000. On the credit side comes to 1,33,040. And the difference 37,960 is the profit to be shared among the partners. Income and expenditure account for the month of December. Expenses amount, income amount. On the debit side, merchandise inventory January 1, 120,000. Purchases 500,000. Purchase return allowances less 15,000. Net purchases 485,000. Purchase discount 14,000. On the credit side, sales 950,000. Less sales returns and allowances 22,000. Net sales 928,000. Merchandise inventory trading account 250,000. Total income is 1,178,000 and the difference of 559,000 is gross profit to be transferred to profit and loss account. In the profit and loss account on the credit side, we have gross profit from trading account 559,000, interest income 4,000, allowance for bad debts and profit and loss account 6,000. On the debit side, the expenses are like this: sales discount 2,000, salaries and wages 128,000, advertising expenses 40,000, rent expenses 50,000, freight out 28,000, interest expense 7,000, miscellaneous expense 128,000, interest on capital 38,040, salaries to profit and loss account 60,000, depreciation on buildings 50,000. Net profit transferred to 3 by 5 fifth share 22,776. Net profit transferred to Chance Capital 15,184. Total 569,000. Total credits 569,000. Balance sheet. Liabilities and owner's equity amount. Assets amount. On the asset side, current assets cash 36,000. Accounts receivable 120,000. Less allowances bad debts 24,000. Net accounts receivable is 96,000. Notes receivable 30,000. Merchandise inventory December 31 250,000. Prepaid advertising 5,000. Fixed assets land 100,000. Buildings 500,000. Less accumulated depreciation 100,000. Net buildings 400,000. Total assets are 917,000. On the liabilities side, current liabilities accounts payable 72,000, notes payable 75,000, outstanding salaries 30,000 and owner's equity towards capital 361,040, towards drawings 20,000, net profit 22,776. Total owner's equity of TUA 363,816. Chance capital 371,000, less drawings 10,000, net profit 15,174. Total Chance capital 376,184. Total liabilities 917,000 and total assets 917,000. Statement of changes in partners capital. Owner's equity TUA Chan capital TUA 361,040, Chan 371,000. TUA's drawings 20,000, Chan's drawings 10,000. Net profit 22,776 for TUA, 15,184 for Chan. Total TUA's capital is equal to 362,816. Chan's capital 376,184. Trading account debtor 656,000 to merchandise inventory January 1 credit 120,000, purchases credit 500,000, purchase discount credit 14,000, sales return and allowances credit 22,000, being the trading expenses transferred to trading account. Closing entry number 2. Sales data 950,000, merchandise inventory trading account data 250,000, purchase returns and allowances 15,000, to trading account 1,215,000, being the revenues, trading revenues transferred to trading account. Closing entry number 3. Profit and loss account data 493,000, to sales discount 2,000, to interest expense 7,000, to freight out 28,000, to advertising expenses 40,000, to rent expenses 50,000, to depreciation on building 50,000, to salaries to Tua profit and loss account 60,000, salaries and wages 128,000, miscellaneous expenses 128,000, being the business expenses transferred to profit and loss account. Closing entry number 4. Interest income debtor 4,000, allowances bad debt 6,000, debit to profit and loss account 10,000. The partners agreed to admit CO as partner with the following assumptions. Assumption 1. CO purchases 1/2 interest of Chan for 200,000. The existing total TOA's capital 363,816, Chan's capital 376,184, and CO is bringing 200,000 as his share of capital. Existing profit sharing ratio is 3:2 among Tua and Chan. CO's admission, the new ratio will be Tua 3, there is no change. Chan, half of the Chan goes to CO. So, Chan's capital sharing ratio comes 1. CO's capital sharing ratio comes 1. Tua is to Chan is to CO is equal to 3:1:1. Assumption number 2. CO purchases 1/3 interest of Chan's for 97,000. So, the capitals existing Tua 363,816, Chan 376,184 and CO is bringing 97,000. Existing profit sharing ratio is 3:2 among Tua and Chan. After CO is admitted, the new ratio will be Tua 3, there is no change, Chan is 1.33 and CO is 0.67.